Key facts. A. General insurance key concepts. 1. Insurance is defined as the transfer of pure risk to the insurance company in consideration for a premium. 2. The chance of loss without any chance of gain is called pure risk. 3. Speculative risk has the possibility for gain or loss and is not insurable. 4. Risk is defined as the chance of loss. 5. A condition that could result in a loss is known as an exposure. 6. A hazard is something that increases the chance of loss. 7. The presence of a physical hazard increases the chance of a loss occurring. 8. A peril is defined as a cause of loss, such as fire. 9. To be insurable, losses must be calculable. 10. The law of large numbers allows insurers to predict claims more accurately. 11. The law of large numbers applies to groups of people, not to individuals. 12. The more people in the group, the more accurate the predictions are. 13. Most insurers buy reinsurance to protect themselves in the event of a catastrophic loss. 14. Insurance laws are not required to be uniform from one state to another. Insurers. 1. A stock insurer may pay dividends to its shareholders, stockholders, but they may not be guaranteed. 2. A reciprocal insurance company is managed by an attorney in fact. 3. An unincorporated association of individuals who insure each other is known as a reciprocal insurer. 4. The government offers insurance primarily based upon social needs, such as flood insurance and workers' compensation, but does not offer insurance for the purpose of preventing fraud. 5. A foreign company has their home office in another state. 6. An insurer incorporated outside of the U.S. who sells in the U.S. is an alien company. Producers and general rules of agency. 1. A producer may be personally liable when violating the producer's contract. 2. Producers represent the insurance company, not the insured. 3. Independent producers own their own accounts and are not insurance company employees. 4. Producers have express, implied, and apparent authority. 5. The authority a producer has that is written in his or her contract is known as express authority. 6. A producer's binding authority, if any, is expressed, written down, in the producer's contract with the insurer the producer represents. 7. The authority not expressly, written, granted but is actual authority the producer has to transact normal business activities is known as implied authority. Contracts. 1. The elements of a legal contract may be remembered by the acronym COAL: consideration, offer, acceptance, legal purpose, and legal capacity. 2. A requirement for a valid contract is offer and acceptance, or mutual agreement. 3. Advertising the availability of insurance is not considered to be an offer. 4. A specific and definite proposal to enter into a contract is known as an offer. 5. The consideration on a policy need not be equal. 5. A policy may not be voided due to unequal consideration. 6. Under the consideration clause, something of value must be exchanged. 7. Because insurance contracts are contracts of adhesion, policy ambiguities always favor the insured. 8. Insurance policies are considered to be unilateral contracts, in that only one party makes an enforceable promise, the insurer. 9. The principle of indemnity states the purpose of insurance is to restore the insured to the same position as before the loss occurred. 10. The principle of utmost good faith states that all parties to an insurance transaction are honest. 11. A representation is defined as the truth to the best of one's knowledge. 12. A warranty is defined as a sworn statement of truth, guaranteed to be true. 13. A breach of warranty may void a contract. 14. Concealment is defined as the failure to disclose a material fact. 15. When an insurer voluntarily gives up the right to obtain information that they are entitled to, they have made a waiver. B. Life insurance basics. 1. Insurable interest must exist at the time of application, but not necessarily at the time of a claim. 2. Insurable interest may be based on economics or family relationships. 3. An insurable interest exists if someone would benefit if another person continues to live. Personal uses of life insurance. 1. Buying a life insurance policy creates an immediate estate. 2. When life insurance is used to pay estate taxes, it is known as estate conservation. 3. A life settlement contract is between the life insurance policy owner and a third party. 4. The human life value approach was created to establish what a family would lose in income upon the death of the sole or chief income provider. 5. The needs approach to life insurance does not consider future earnings. Business uses of life insurance. 1. Stockholders in small, privately held closed corporations often enter into buy-sell agreements with the corporation that are funded by life policies. 2. A policy that provides for business continuation in the event that a business partner dies is based upon a cross-purchase buy-sell agreement. 3. A corporation may buy a policy on a shareholder to provide for stock redemption in the event of the shareholder's death. 4. A stock redemption plan is an agreement whereby a corporation agrees to buy back the stock of a deceased shareholder. 5. Examples of third-party policy ownership include key person and partnership insurance, as well as a policy written on the life of a spouse or minor child. 6. Under an executive bonus, the premium paid to the employee as a bonus is deductible by the business, and the amount paid to or for the employee is reportable as taxable income to the employee. 7. When life insurance is purchased as an executive bonus for a corporate employee, the policy belongs to the employee. Underwriting. 1. Life insurance mortality tables are based upon people and time. 2. A 60-year-old male has a higher mortality rate than a 60-year-old female. 3. Life insurance premiums are based on mortality, death, plus company expenses minus interest earned on company investments. 4. Agents, producers, are also known as field underwriters. 5. If a producer gives an applicant a conditional receipt and the underwriter rejects the application, there is no coverage. 6. Conditional or binding receipts are used in life and health insurance. 7. Binders are used in property and casualty insurance. 8. A conditional receipt is not given to an applicant unless the initial premium has been paid. 9. Applicants may backdate a life insurance application for up to a specified number of months, usually 6 months, in order to obtain a lower premium. 10. An incomplete application is usually returned. 10. However, should the underwriter approve it, coverage begins and the company has waived its ability to contest a claim. 11. The earliest that coverage could start would be the day of application, assuming the applicant paid the first premium, had no conditions to fulfill, and had not lied on the application. 12. Coverage can never begin unless the premium has been paid. 13. The HIV consent form states that the results of an HIV test will only be shared with certain individuals, such as the underwriter. 14. Life insurers may discriminate based upon physical hazards, age and health, of the applicant. 15. The company underwriter determines the final rating classification, not the producer. 16. A preferred risk is likely to receive a premium discount. 17. A standard risk is one with an average lifespan. 17. Most applicants are standard risks. 18. A rated policy is one issued to a substandard risk with dangerous hobbies or health problems. See types of life policies. Term life insurance. 1. Term insurance is renewable without a physical examination, up to a certain age. 2. Term insurance may be converted to whole life, but not the reverse. 3. Conversion is based on the insured's current age. 4. Convertible term is convertible based upon the current or attained age of the insured. 5. In a level term policy, the premium and the amount of coverage are level throughout the term. 6. On an annual renewable level term policy, the premium will increase every year, although the face amount will remain the same. 7. The face amount of a mortgage protection life insurance policy will decrease at the same rate as the mortgage balance declines. 8. It is the face amount that decreases on a decreasing term policy, not the premium. 9. Decreasing term is the type of life insurance provided in mortgage redemption insurance. Whole life insurance. 1. Whole life policies must contain a table showing their guaranteed cash value at the end of each year, anniversary date, for the first 20 years. 2. It is shown per unit, per thousand. 3. Whole life benefits are bundled, packaged. 4. Universal life benefits are transparent, stand alone. 5. Whole life and limited pay life both reach maturity at the same time, age 100. 6. In a traditional whole life policy, premiums are due until the insured dies or reaches age 100. 7. Conversely, in a limited pay policy, the premiums are paid for a shorter period of time. 8. Straight or traditional whole life has a level premium and will provide coverage until the insured dies or reaches age 100. 9. Whole life insurance will pay the face amount upon death or age 100, whichever comes first. 10. Limited pay whole life insurance has limits that pertain either to the number of years payments must be made, such as 20 pay life, or the age by which all premiums must be paid, such as life paid up at 65. 11. Limited pay whole life policies, though paid up earlier, do not mature until the insured reaches age 100. 12. On a 20 pay life, the cash value will equal the face amount at maturity. 13. A single premium may buy a policy that is paid up for life. 14. A single premium policy has an immediate cash value. Flexible premium policies. 1. An adjustable whole life policy may be suitable for someone with fluctuating income. 2. Adjusting the premium paid on an adjustable whole life policy will affect the face amount, and vice versa. 3. Universal life insurance is different from whole life because it has a premium that is flexible. 4. Universal life insurance policies permit their owners to take partial surrenders. 5. Taking a partial surrender on a universal life policy allows the policy owner to withdraw some of the cash value without paying tax on the interest. 6. Universal life insurance is also known as interest-sensitive whole life. 7. Universal life is a combination of 1-year renewable term and a cash value account. 8. Universal life offers flexible premiums and a minimum guaranteed rate of return. 9. Loans are allowed on universal life policies. Variable life. 1. Variable whole life allows the insured to self-direct the cash value investment. 2. Variable products have no guarantees and are not backed by the guarantee fund. 3. Investing in variable products is considered a hedge against inflation. 4. A universal life policy that has an investment component is called variable universal life. 5. A life insurance policy that invests its cash values in equities is known as variable life. 6. A life insurance policy that has a flexible premium and allows the policy owner to self-direct their cash values into equities is known as variable, universal life. 7. An agent must be registered with FINRA in order to sell a variable product. Specialized policies. 1. A joint life policy pays only when the first insured dies. 2. A joint and survivor life policy pays only when the second insured dies. 3. Survivorship life insurance is commonly used in estate planning, so the death benefit of the policy can be used to pay estate taxes when due. 4. Survivorship life pays when the surviving insured dies. 5. A juvenile life insurance policy is a life insurance policy written on the life of a minor. Group life insurance. 1. On group life insurance, the employees receive a certificate of insurance that summarizes coverage and lists the employee's beneficiary. 2. In group insurance, the policy owner, who is usually an employer, is issued the master policy. 3. In a contributory group life insurance policy, 75% eligible employees must enroll. 4. In a non-contributory group life plan, employer pays the total premium. 100% of all eligible employees must participate. 5. Individual policies are usually more expensive than group. 6. On group life, the employer may require an employee to pay the premium for dependents coverage. 7. Group insurance participation requirements help to avoid adverse selection. 8. A group cannot be formed just to buy insurance. 9. Experience rating is for large groups only. 9. Rates are based on claims experience of the group. 10. Conversion from a group life policy to an individual policy when employment is terminated is permitted for 31 days, regardless of health. D. Policy provisions. riders, and options standard provisions. 1. Although producers must sign the application, they are not a party to the contract. 2. It is the responsibility of the producer to explain the policy provisions, riders, and exclusions to the applicant. 3. The owner's rights section of a life policy states who has the right to change the beneficiary, who can take a loan, and who can take cash surrender. 4. Owners of life insurance policies may temporarily assign their life insurance policy to a bank as collateral for a loan, which is known as a collateral assignment. 5. The policy is the sole collateral for a policy loan. 6. Policy loans are not taxable. 7. The owner of a life insurance policy may transfer his or her ownership to another person by making an absolute assignment. 8. The entire contract includes the policy and anything else attached at issue, such as the application. 9. Producers may not make changes to a policy. 9. Policy modifications must be in writing and signed by a company officer. 10. Under the life insurance free look, a policy owner who returns their policy 5 days after delivery will receive a full refund since the free look is commonly 10 days. 11. A policy owner may exercise the free look provision without giving any reason. 12. The free look period, usually 10 days, starts upon policy delivery. 12. If the policy is mailed to the applicant by the company, the free look starts on the date of mailing. 12. This is called constructive delivery. 13. Ordinary life insurance has a grace period of 30 days. 14. A life insurance policy provision that allows coverage to continue even if the premium is not paid on time is known as the grace period. 15. If a terminated employee dies within the grace period of his or her employer-provided group life policy without converting, the full death benefit will be paid to the beneficiary. 16. When an insured dies during the grace period without paying the premium due, the face amount will be paid to the beneficiary, less the overdue premium. 17. If an insured whose policy has lapsed wants it back, the insured can apply for reinstatement. 17. Upon policy reinstatement, the incontestability and suicide clauses start over. 17. A life insurance policy that has been surrendered for cash may not be reinstated. 18. Life insurance policies are incontestable after they have been in force for 2 years. 18. New life insurance policies are contestable for material misrepresentation for the first 2 years. 19. Under the misstatement of age provision, if an insurer discovers that an insured has misstated his or her age on the policy application, the insurer will adjust the premiums and benefits according to the correct age of the insured. 20. The misstatement of age provision runs for the duration of the policy. 21. Under the misstatement of age clause, if the insured understates his or her age, it is the face amount that is reduced. 22. Proceeds of a life insurance policy, left with an insurer, for the benefit of a beneficiary, may not be attached by creditors. 22. Proceeds cannot be directly paid to a minor child since a minor can't sign a release. 23. If the insured dies in an accident, the insurer may order an autopsy to determine that death was not the result of a suicide. 23. In most states, suicide is covered after 2 years. 24. If an insured commits suicide within a specified period of time after policy issue, usually the first 2 years, no benefit is payable, but all premiums are refunded to the beneficiary. 24. Check your state regulations section for the time limit in your state. 25. If an insured buys a life insurance policy and dies 1 month later, the insurer must pay the claim. Beneficiaries. 1. When a policy owner lists a group of people as beneficiaries, it is known as a class designation. 2. Life insurance proceeds create an immediate estate for the beneficiary. 3. The beneficiary does not have to be of the age of majority, 18 or 21, depending upon the state, in order to receive policy proceeds. However, proceeds cannot be directly paid to a minor child since they cannot sign the release. 4. If the insured names an individual as their irrevocable beneficiary, the insured cannot change this designation without the beneficiary's consent. 5. A revocable beneficiary may be changed at any time by the policy owner. 5. A revocable beneficiary has no vested rights under a life policy. 6. An irrevocable beneficiary has a vested interest in the policy. 7. A contingent beneficiary will receive the policy proceeds if the primary beneficiary dies before the insured. 8. Under the common disaster provision, it is assumed that the insured died last. 9. If the policy proceeds are paid out in a lump sum, the spendthrift clause will not apply. Policy loan and withdrawal options. 1. Failure to repay a loan will have a permanent effect on cash value accumulation. 2. The annual interest on a life insurance loan is added to the amount of the loan as it accrues. 3. If an outstanding policy loan, plus interest, exceeds the cash value of the policy will lapse. 4. A loan may be taken from a whole life policy as soon as it develops a cash value. 5. The automatic premium loan rider can be added to a whole life policy, but not to a term or credit life policy. 6. Partial surrenders are usually allowed in annuities, universal life, and variable life policies. Riders. 1. Waiver of premium is a rider that will pay the premium on behalf of a disabled insured, after a short waiting period, until the insured either recovers or dies. 2. The waiver of premium rider does not pay a cash benefit to the insured. 3. If a parent paying the premium on a child's life insurance policy dies, the provision that allows the premium to be waived is known as payer benefit, not waiver of premium. 4. If the payer benefit rider is attached to the policy, an insured will not have to worry about premiums being paid if the policy owner dies or becomes disabled. 5. The accelerated benefits rider will pay proceeds prior to death for those with a terminal illness. 6. The change of insured rider may be utilized by an employer who wants to transfer a key person life insurance policy from one key person to another. 7. On a term life rider added to a parent's policy to cover the life of a child, the child's coverage terminates when the child reaches age 18, unless the child converts the rider to permanent coverage. 8. When adding a children's term rider to a life insurance policy, all of the insured's children are covered for a single, flat premium charge, no matter how many. 9. A level term rider may be added to a parent's life policy in order to insure a child. 10. A combination policy that automatically covers all family members, including newborn children, after a short waiting period, at no extra premium charge is called a family policy. 11. The guaranteed insurability rider is also known as the guaranteed purchase benefit. 11. The guaranteed insurability rider allows the insured to increase coverage periodically without a physical exam. 12. If a person purchases a whole life policy and adds a return of premium rider, they will have level coverage from the whole life policy, and increasing coverage from the rider. 12. The return of premium rider and the return of cash value rider are both types of increasing term coverage. Non-forfeiture options. 1. Surrender charges levied by some insurers on annuities and universal life will reduce the amount a policy owner will receive upon cash surrender. 2. If a policy with a cash value lapses for non-payment, the insured has 60 days from the premium due date to select a non-forfeiture option. 3. Extended term is the automatic non-forfeiture option. 4. When the reduced paid-up non-forfeiture option is selected, the amount of coverage in the new policy is reduced from that of the original policy. 5. The reduced paid-up non-forfeiture option may be taken anytime there is a cash value. 6. The reduced paid-up non-forfeiture option will provide coverage for life. Dividend options. 1. If an insured with a life insurance policy issued by a mutual insurer allows the insurer to keep the dividends but mail the insured a monthly check, the insured has chosen the interest option. 2. On a participating life insurance policy, if the policy owner selects the one-year term dividend option, the dividend may be used to buy term insurance. Settlement options. 1. If the insured owner of a life policy does not designate a settlement option prior to death, the beneficiary may choose whichever option he or she wants. 1. Most choose cash, which is not taxable. 2. If the interest settlement option is selected, the interest paid is subject to taxes. 2. When a beneficiary selects the interest-only settlement option, Interest payments, which are taxable, will vary, but the beneficiary may withdraw the principal at any time. 3. For estate conservation purposes, a beneficiary should select the interest-only settlement option. 4. A life insurance beneficiary who elects to take the proceeds payable upon the death of the insured over a period of time has selected the fixed-period settlement option. Federal tax considerations for life insurance and annuities. Taxation of personal life insurance. 1. Death benefits paid to beneficiaries are tax-free on all life insurance. 2. Dividends which are paid out by mutual insurers are not taxable to the policy owner because they are considered to be a return of the premium paid by the policy owner. 3. Dividends received by the owner of stock in a stock company are taxable as ordinary income. 3. Dividends are never taxed as capital gains. 4. A cash surrender where the amount received is more than the amount paid in premiums would cause a taxable event. 5. Surrendering a life insurance policy for cash and using the proceeds to buy a new life insurance policy from a different insurer is a tax-deferred 1035 exchange. 6. On cash surrender of a life insurance policy, amounts received in excess of premiums paid in are taxable. 7. In group life insurance, benefits are not taxable to the beneficiary should the employee die. 8. Premiums paid for individual life insurance are not tax-deductible, nor are benefits taxed. 8. This is true of key person life insurance as well. 9. Life insurance policy owners who gift their policies to a charity are entitled to a tax deduction in the year of the gift. Modified endowment contracts, MECs. 1. Modified endowment contracts, MECs, lose their favored tax treatment as life insurance since the IRS considers them to be investments. 2. MECs are classified that way for the life of the contract. 3. A modified endowment contract that is classified as life insurance but fails the 7-pay test would have taxable loans and withdrawals. 4. Making a material change to a cash value life insurance policy may cause the 7-pay test to be applied again and could cause the policy to be classified as a modified endowment contract. 5. Modified endowment contracts have a 10% IRS penalty for premature distributions. Arkansas statutes, rules, and regulations common to life and health insurance. Definitions. 1. A domestic insurer is formed under the laws of this state. A foreign insurer is formed under the laws of another state, and an alien insurer is formed under the laws of another country. 2. A fraternal benefit society must operate for the benefit of its members and their beneficiaries. 3. Stock insurers are owned by their stockholders. 3. Mutual insurers are owned by their policyholders. 4. Transacting insurance is broadly defined, including soliciting insurance, effecting a contract of insurance, or conducting matters subsequent to effecting an insurance contract and arising out of it. The Insurance Commissioner. 1. The Insurance Commissioner is appointed by the Governor and serves a 4-year term. 2. Although rates may be subject to approval by the Commissioner, they are set by insurers. 3. The Commissioner must examine, audit, each authorized insurer every 5 years. 4. The Commissioner must give at least 10 days advance notice of the time and place of a hearing and state the matters to be considered. 5. If a person is aggrieved by a cease and desist order, they can request a hearing before the Commissioner, which must be held within 30 days of the entry of the order. 6. The Commissioner may impose civil penalties, but not criminal. 7. For a violation of the Insurance Code, the Commissioner may levy a maximum fine of $1,000 per violation, not to exceed $50,000, for all such violations in any 6-month period. 8. Any person who violates a cease and desist order related to unfair or deceptive acts may be subject to a fine of up to $10,000 and/or license suspension or revocation. 9. The Commissioner may suspend an agent's license for up to 36 months for committing an unfair trade practice, or permanently revoke it. 10. Any person convicted of violating statutes regarding misrepresentation is guilty of a Class D felony. Licensing. 1. Individuals engaged in the sale, solicitation, or negotiation of insurance contracts for a commission must be licensed as agents. 2. Although insurance consultants must be licensed, they are exempt from the pre-licensing training requirements. 3. Temporary licenses may be issued for no more than 180 days. 4. Although an agent must have at least one appointment, they can have as many appointments as they want. 5. Insurance producers must complete 24 hours of CE every 2 years, of which 3 hours must be ethics. 6. The 24-hour insurance CE requirement applies per licensee, not per license held. 7. Reinstatement of a license suspended for failing to report or obtain the required CE requires the payment of a fine of $150 if reinstated within 1 year. 8. Producers must report any change in address or name to the commissioner within 30 days of the change. Producer responsibilities. 1. Producers represent their appointing insurer. 2. Agents must keep at their place of business the records that pertain to transactions under their license for at least 5 years. 3. Insurers may pay deferred commission to persons who are not currently licensed but who were licensed at the time a policy was sold. 4. A person who fails to report a fraudulent insurance act would be guilty of a Class A misdemeanor. Insurance Guarantee Association. 1. The Insurance Guarantee Association is designed to protect the policy owners, insureds, and beneficiaries from insolvent insurance companies. 2. All authorized insurers must be members of the Guarantee Association and are subject to assessment. 3. Producers and insurers are prohibited from referring to the Guarantee Association in any advertisements or using its existence as an inducement to the purchase of insurance. Marketing practices. 1. It is not unfair to deny a claim after a reasonable investigation indicates that there is no coverage. 2. Paying dividends is not considered to be rebating as long as the policy states that the insurer might do so. 3. Guaranteeing future dividends is considered to be a form of misrepresentation. 4. Defamation is defined as making oral or written statements that are false or maliciously critical to the financial condition of an insurer. 5. Insurers may not unfairly discriminate between individuals of the same class and equal expectation of life in the rates charged, or in any other of the terms or conditions of the policy. 6. Twisting the facts is an unfair or deceptive practice. 7. Although replacement of life or health insurance is not unlawful, it must be for the benefit and betterment of the insured, or it is considered to be churning of business. Thanks for watching.